All right, Kev. It's time to move on, and I wanted to talk to you about the stock markets in particular. If we're going to, obviously, we don't know the resolution to the G20 meeting and how the market's going to react, but there is two very distinct camps. One that is saying the stock market's going higher, and which is you, and me, which is that it's we're on the verge of a bear market and the stock market is inevitably going to buckle. And which one is it? One of us is going to be spectacularly wrong, and the other is going to have gloating rights for how long when we get a resolution to this, because there's no compromise between this, is there?
Well, we're Canadians. We like to kind of saw it down the middle a
Oh
little
no,
more.
we're going to salt it pretty hard here when it comes down to
Well,
it.
anyways, let's just go on to this great chart that you pulled out. Who is this? Morgan Stanley that talked about this?
No, I think this came from J.P. Morgan.
J.P.
Uh,
Morgan. And
yeah,
when you brought this to my attention, I was like, this chart actually brings together the issues facing the market so well. And the two different kind of analogies that it brought up was whether we were going to have a 1998 style kind of one or two cuts, which then gives the pause that refreshes and allows the market to go on from there, or whether we're going to have a 2000 or 2006 cut that ushers in kind of the next recession.
right.
And I thought it was really a telling thing, because ultimately that is where we differ, Patrick. Whereas you look at all the weakness in the economy and say it's a harbinger of things to come, I say that no, maybe we're going to get a little bit of a cut here, and the fact that bonds have
Right.
kind of rallied so hard and rates have gone down will actually give the fuel for the next leg of the economic move higher.
Right. So the key thing, just to clarify for our listeners, is that there's two camps. One is that in 1984, 1995, and 1998, in each of those situations, the Fed did a cut that was usually a one and done, like a quick stimulus, an insurance cut, and then refired up the economy and and the economy started going again. Versus in 1989, in 2001, and 2007, when they did cut, it was the first cut of a sequence of recession cuts, which is then heading towards zero as they're cutting interest rates to re-stimulate the economy back up again. And the question is, which one is it going to be? And my question I have for you, Kev, is that the market has priced in the cut. I think you won't dispute that.
No, for sure. It's
The
priced into
market
more than one cut. It's priced in
is
three cuts.
exactly. So it's priced in the cut. So if it was an insurance cut that the Fed was providing, was just a cut just to kind of keep things moving along, why wouldn't they have done it already if the market gave them permission to do it? Why wasn't June the rate cut? I mean, if it was just a insurance cut to kind of get the market started again, why are they going to keep waiting? Like, if it's an
Oh,
insurance cut, they should have already done it, and the market already priced it in.
I don't know, Patrick. That's a dumb argument, bud. Like
What?
that's like yeah. Like
Oh, what
that's
do you mean
like
it's a
because
dumb argument? Because you don't have an answer for it?
no, but like what you're arguing that the Fed, because the market gave them the go ahead, they should have actually got it like ahead of the curve and done even more than the market was expecting.
Not
'Cause
more
let's
than the
face
market's
it,
expecting.
no, nobody was expecting a cut in June.
But it's priced in.
No,
If it's
but
an
it was
insurance
priced
cut.
in. The July was priced in. It wasn't priced in June.
But even now, Bullard is talking about whether or not it's prudent to cut in July. And so
Okay, so that's a different argument. That's like whether they're trying to walk it back and take out the July cut. I would argue that Bullard is trying to walk back the fact that many parts of the market were starting to price in 50 basis points in July. And he was trying to cement it as like, no, you're only getting 25. That's all he was doing.
so
So like you're
I,
trying
I
to say
think they're
that
just I just
that-
think they're going to be too late. Kev,
So
I think they're going to be too late.
you think that the July that the difference in 1 month is going to be the economy is that much on the teeter totter, and that it's going to tilt the other way because they waited an extra month to cut? Is that what you're telling me?
I just think that this is not a one and done insurance cut, and that they are waiting. What's happened? If you go back and look at, like, actually, this next chart does a great job, kind of talking about where the recessions were, and this is the New York Fed's recession probability. Odds of the probability of a recession indicator, and we're at like 30% right now. But the point is that in all of the recessions in the past, right after the rate cut, whenever it came, it only took about 2 to 3 months for the U.S. economy to be in a recession after the fact, if it was in fact a recession cut. So it wouldn't happen if it was one of the your little insurance cuts where they just kind of come in there, stimulate the economy. So if they're waiting till let's say July or September to make the cut, then suddenly we may be in a recession by the end of the year.
Well, of course, you're so bearish on the economy. You look at it and you say, what are they doing waiting? They should be going at, like, the market's already given them the go-ahead for July. They should get ahead of it and actually do June. That's your argument.
That's not what – no. I'm saying my argument is that if it was an insurance cut like you actually think it could be, I think they should have already done it. I think if they were trying to give a stimulus, just as the economy was rolling over and slowing, they're going to give it an adrenaline shot to kind of fire it up again and get another wave of bullish upside on the market, then they should have already done it.
Yeah, so I take the other side of that, Patrick, because I think that the market pricing in July versus June, it doesn't matter. The whole curve has already reflected the July cut. So I disagree that it really is going to matter that much to the real economy, whether they do it in June or July.
Right.
And I'll just, we'll agree to disagree there. I don't think it's
so.
Go ahead,
on this last chart, so this is that New York Fed recession probability versus the actual recessions when they happened. There was only one time in the 1960s where their probability of a recession indicator was this high and it didn't result in a recession, and 8 times that it did. So are you basically saying this is that 1 in 8? Are you saying this is like the 1960s?
No, but Patrick, you have to realize there's a lot more than just like when you look at the whole picture. Like, tell me how many times 8 years into a cycle we've had a tax cut to the effect that Trump did his tax cut.
Right.
Like, tell me how many times you had QE going on around the world. I'm not like some huge, just everything's great, kumbaya, the world's terrific, and therefore stocks are headed higher. But I do think that it's a very different environment than the environment that you're using when you're going and looking at these things. And I argue that if they go and they do a cut and they stabilize kind of the worries, that I'm not so sure that we can't go longer and we can't have an expansion that is a record long expansion. Like, look, Australia went 25 years or something without having a recession.
Oh my God.
And no, but like,
I know they
Patrick,
have, but
yeah. And I'm not saying it's the right thing. Don't get me wrong, because I'm going to get all sorts of people saying that it's like we're distorting the economy, and so be it. I maybe we are. But talking about what's right versus what's going to happen are two very different things. And you have to admit that all the people that have been bearish, like a lot of these arguments that you guys are making could have been made 3 years ago.
All right. So
do you not disagree there?
Yes, I was making that argument 2016, and I was wrong. I'll admit that. So you know what's my thing with you? You know what I've noticed about you, Kev, is that you absolutely at your core need to be a contrarian. Whenever everybody is in consensus on something, you just cannot, for whatever reason, agree with them. You have to take the other side of it. And so, so I envision you, and you on each shoulder you have like that little macro tourist angel on the one shoulder, and the little macro tourist devil on the other, and the little devil's whispering in your ear like, you can't agree with these people. It's just there's too many people that agree. And it's like you're standing on a train track, and the train tracks are rattling around the corner. There's something coming, and you're standing on the tracks, and that little macro tourist is whispering in your ear, don't be such a wuss. It's nothing's gonna happen here. You're gonna be fine.
Don't be such a Sally.
Don't be such a Sally.
Exactly.
And you're just and you're all in. You're standing on those tracks, and
so
all
Patrick,
the evidence is there.
You know what? So far, betting against the end of the world has been a good trade. All of these hedge funds that have been telling me that they've consistently been bearish the whole way up, and I'm not bullish for the reasons that the kind of the perma bulls are bullish, but I am a believer that when you put rates to zero and you do weird things in the economy, weird things happen to asset prices.
Yeah.
So I just think that more and more, a lot of these kind of these systems that you used to use, they don't matter as much. I saw one of my, I don't know if it was Ben Hunt or the Hayek and Keynes guy on Twitter talked about the fact that he said something to the effect, there's a famous strategist from Toronto that was putting some sort of, bearish economic news out there and talking about why the stock market was going to go down. And his reply was, I think actually now that I think about it, it was Ben. His reply was, since when has fundamentals mattered for pricing the stock market? And that's the part that I kind of disagree with you about.
Well, okay, no. What I would disagree with that statement is that fundamentals or overvalued markets often are not a catalyst for a turn in the markets. But ultimately, because they're not a catalyst for a turn, that doesn't mean that overvalued markets are not seen, for instance, at market tops. So they lack the ability to be the immediate catalyst. You usually need something to drive the turn that is beyond just overvaluation. Is that a fair way to describe it?
Yeah. But you know what we should do? We should go back to the original chart. Can you go back a chart?
Yeah.
Because what I like to do is kind of give people a roadmap and say, if you believe that, like Patrick, that the world's ending tomorrow, the economy is about to plunge into a recession, and that
follow
go
the red
get your
line.
guns and ammo, then you're
absolutely.
God.
You're the guns and ammo guy because you're a bearer on bonds.
No,
and
anyways,
anyways.
So Patrick, let me just finish. So I completely agree. If you end up being right about the economy and it is as bad as you think it is, then go use the playbook from 2001 and 2007. Like I'll take that. I completely agree with you. And I'll be proven wrong, and when it gets there, so be it. And I'll tell you what I'm looking for in terms of when that playbook will be more obvious to me, when I see a real pickup in unemployment. Until then, I'm not sure, and we'll see. But that would be the sign to me that I have to start thinking very seriously of that I'm wrong. And you might say by then it's going to be too late. Very well could be. Not going to disagree with you there.
Yeah,
but that's what I'm looking for.
There's no, jobs numbers are not a leading indicator. They're
lagging,
but
right? You can see in the private payroll numbers, the weekly payrolls, the pickup and stuff. And that's what I'm looking. At the margin, that's what I'm scared about. And listen,
all right,
I'm a trader, so I might be wrong, and I'll tell you that I might be wrong. I'm not wedded to my idea. If this ends up being the playbook, then great. I will jump on it and I will say I was wrong, and I'll
buy the dip when you're jumping in.
Well, maybe, but the reality is that you're going to have a long way to go because you've been short for the last,
Oh my God.
We're sitting in new highs, and even though everyone's telling me the economy is about to roll over, it's the end of the world, they're also very confused about why stocks are sitting at all-time highs. And you're going to say, well, it's idiots like me that are buying the stock market, and I would say that no, there's something more fundamental going on that and you have to kind of think about what might be different. But anyways, so right. I think that we're more likely to be in a 1984, 95, 98 scenario, at which point that we're going to get a move higher. And right. I think this is a great chart for everyone because very quickly you can decide where you want to be. Do you want to be betting on my bet that basically this is the pause that refreshes and that the amount of stimulus in the system is going to push us to even stupider levels? And don't get me wrong, I believe all this is stupid levels. It's not like I think this is great value and you should be buying stocks hand over fist. But I do believe that bonds are even stupider than stocks. If you think that bonds, buying like 10-year bonds at 2% when the Fed has a 2% inflation target is a good trade,
I'm honestly not getting pushed into this argument because I totally disagree with you, and I think me and you have an appointment on a stage.
That's right.
Where this is going to be done on. So I'm not going to give away my good stuff.
Okay.
By you
anyways,
but
for listeners, make sure you look at this chart. This is a very important chart. It very clearly defines the two different camps. Have a look. Make your decision. Watch for it. You know what? Maybe you're in one camp today and then you'll be in another camp tomorrow. Good trader changes his or her mind based upon the facts. So far, I continue to believe that this looks more like 98 and 95 and 84 to me than a 2001, 2007. But if I'm wrong, I'll change my mind. But till then, I'm still betting on that we're headed higher.
You're all in, buddy. Forget it. That you're not getting off the railroad tracks until after you've been flattened, buddy.